Following the Russia-Ukraine crisis early this year, global tensions across several other regions are currently on a rise. For instance, North Korea has reportedly fired at least one ballistic missile towards its eastern sea as part of its weapons test that have raised tensions in the region. Meanwhile, Saudi Arabia has shared intelligence with the US about an imminent attack on the kingdom by Iran. These fresh geopolitical worries, analysts warn, could prove to be a bigger concern for the markets over the next few months rather than central bank policy actions.
Geopolitical situation happening in very crucial part of the world definitely has a major headache for the markets and also for the growth, economic growth and all. Because it leads to a lot of disturbances, not only in terms of supply of crucial energy, which is needed especially during this time of the year when the winter is likely to be harsh, but it also has an impact on certain nations with respect to the food security. Now, both these events are very important and integral to the markets across the globe. And in case if there is going to be any unfortunate misadventure by certain part of the leaders in respective countries, then definitely it will have an overhang more than the inflation concerns or the growth rates slowing down. Geopolitical tension will come at number one when it comes to likely possibility of what can impact the markets in the future.
Sharing similar views, G. Chokalingam, Chief Investment Officer at Economics Research, says major world economies cannot afford a slowdown now. As it is, the world economy is reeling under the impact of the Russia-Ukraine war and tensions between China and Taiwan. Any further escalation will impact growth and markets that have not yet fully priced in this possibility. Meanwhile, on the policy front, the US Federal Reserve delivered a 75 basis point rate hike on Wednesday, cautioning against prematurely pausing the tightening cycle, which dented investor sentiment.
But stocks, of course, we can see didn't like the language, and the S&P was down 2.5%. That's the worst performance of the S&P on a Fed decision day since January 2021. Futures are basically flat in Asia this morning. The way I would interpret it is the Fed wanted to acknowledge that a lot has been done. And we know from some of the commentary over the last few weeks from people like Vice Chair Brainerd, San Francisco Fed President Daly, Chicago Fed President Evans, that we know from them that some Fed officials think 75 basis points going forward is too much for the market to handle. So they wanted to signal that they might scale down the pace of the rate hikes. But they also knew going into the meeting that so many market watchers were already saying the Fed's going to be less hawkish, and the S&P had risen 10% from its low on the 12th of October. The Fed doesn't like it when the market is in control. It likes to be in control. So it took back control by saying that, yes, the rate hikes will be less big, but they'll also be more spread out, so it'll last longer. I would say that having already had such a good October, up 8% in the month of October, the S&P could easily give some of that back, but we think it can grind higher between now and the end of the year. Technology is still a sector that's in some turmoil. But the forward-looking inflation readings are continuing to show that inflation is coming down.
However, analysts now expect the US Central Bank to slow down its pace of hikes going forward. Philip Murray, a senior US strategist at Rabobank International, said he expects a 50 bps hike in December, followed by 2 hikes of 25 bps each in February and March, which would take the top of the target range to 5%. According to Murray, inflation is persistent and it will take time to bring it back down toward the US Fed's 2% target. The FOMC will remain on hold for the remainder of 2023 after reaching the terminal rate. That said, Aditya Birla Fashion, Cipla, Britannia Marico, TVS Motor and Escorts will be on the street's radar today, ahead of their September 2022 quarter earnings. Foreign investor flow and the level of the rupee will also guide market sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.